So, Rohit, are you aware of SLMA, uh,
No.
Secondary Loan Market Association of India? So
Uh-huh.
it's a very new development. I'm very excited about it. I'm
I see.
hoping
I
that there
see.
will be room for empirical research as well.
Right. Right. There is also a loan sale platform, which I think is part of that same initiative.
It's
Uh,
very new. So I reached out to them.
okay.
I think this just started a couple of months ago. So maybe you're
Okay.
talking about something else.
Okay.
So there is a platform for secondary loan transactions, you're saying?
Uh, it is also in the works, or it
Oh,
was in the works when I was hearing about it. So it might be the same thing.
it could be the same, yeah.
Yeah.
I guess we could start now. Good evening, everyone. This is a beautiful evening in Ahmedabad today. Quite pleasant. And it's also a good day to talk about an emerging research area in India. On behalf of the chair of the Mishra Center, Professor Abhiman Das, a professor of economics, I welcome you all to today's research webinar. I am Prashant Das, a professor in the finance and accounting area of IIM Ahmedabad, specializing in real estate. I am joined today by my colleague, Professor Bala Gopalakrishnan, also a faculty member in the finance and accounting area, who will be co-hosting the session today. We are privileged to be joined by our presenter, Professor Rahulprasad, who will soon be introduced by Professor Gopal Krishnan. This webinar is the latest in our series of research presentations by academics from all over the world and is organized by the Mishra Center of Financial Markets and Economy. The Mishra Center is a center of excellence at IIM Ahmedabad, sponsored by generous industry leaders, and we aim at fostering applied research related to various financial markets of India to influence both public awareness and policy making. Our focus areas within the financial markets are quite wide and include topics such as central bank's mandate, monetary policy, fiscal developments, banking, SME financing, financial inclusion, insurance, and of course, real estate. In addition to academic research, we also work on spurring dialogue with industry leaders on various topics and involve panelists as well as audience from all over the world. So I also take this opportunity to welcome our audience from different parts of the world this evening who have joined us, perhaps in some very odd hours in some cases due to time differences. And without much ado, I will now pass the baton to Professor Gopal Krishnan.
Thank you, Prashant. Welcome, Professor Prasad. So Dr. Rahulprasad is a professor of economics at MBA Gurgaon. He has a PhD in economic theory from SUNY Stony Brook, USA, where he was taught game theory by the Nobel laureate Professor Robert Aumann. After his PhD, he worked in the software industry in both USA and India in senior management positions before joining MBA Gurgaon. His research interests include the economics of information and communication technology, the markets for distressed debt, today's topic, and also sustainable development. His papers have been published at leading international journals, including Telecommunications Policy. He has delivered seminars and talks at Harvard University, the Center for Game Theory at Stony Brook, India Telecom 2009, and FutureCom 2010. His articles appear regularly in the Mint and in the Economic and Political Weekly. His book, The Dynamics of Spectrum Management, which is co-authored with Dr. V. Sridhar, was published by the Oxford University Press in 2014. He is the author of a popular book on entrepreneurship, Startup Sutra, and Blood Red River that examines the contours of development conflict in India. Both books were published by Hatchett. He is also the author of Game Sutra, Rescuing Game Theory from Game Theorists, a collection of essays published by Sage on current affairs from a game theoretic perspective. On this book, Nobel Prize winner Professor Aumann wrote, entertaining, informative, and fresh. It's strongly recommended to anyone who is interested in discovering how human interactions work. He recently served on a high-powered committee of the RBI on a comprehensive review of the working of the bankruptcy ecosystem. He has also served on a high-powered committee of the Department of Telecommunications, Government of India, to make recommendations on spectrum allocation and pricing in India, and on 2 other expert panels for the Telecom Regulatory Authority of India, TRAI, to study the value of 2G spectrum. Professor Sridhar, on behalf of IMA and also the Mishra Center, I welcome you to this presentation. Over to you, and we look forward to an engaging discussion. Thank you.
Thank you so much, Bala. Let me share my screen, which you can now see. Right. All right. So good evening, friends, and good morning and good afternoon to those who may be joining in from other locations. It is indeed an honor to speak at the Mishra Center for Finance and Economy. So thank you very much for your invitation. Today's talk, Designing a Market for the Securitization of Non-Performing Loans, is dedicated. I think if I start I'm not able to scroll for some reason. Yeah, sorry. So this talk is dedicated to the late co-author of this work, Yogesh B. Mathur. As I was mentioning to Prashant and Bala just before this talk, Yogesh was a career finance professional, and he brought an immense amount of practical insight into our work together. So his going was both a professional and a great personal loss to me, and I dedicate today's talk to him. I'll start with some background on the ARC market, the asset reconstruction companies market in India, discuss some market trends, and then come to the meat of the presentation, which is market redesign through a gains to trade model. And then we'll end with some policy takeaways. A little bit of background, as everyone knows, there is a sizable NPA problem globally and in India, and it's a growing problem. The solutions to the NPA problem include the recapitalization of banks, the sale of NPAs with or without securitization, and then, of course, bankruptcy resolution. And in India, this bankruptcy resolution can either occur through the IBC process, which kicks in if an NPA has a tenure of more than 180 days, or through what's called a pre-pack process, where before the NPA enters the IBC process, the creditors can enter into some kind of agreement with the debtor. So these are the 3 ways in which the NPA problem can be addressed. And today I'm going to talk about the sale of NPAs. Now, this market for NPAs was created by the Sarfazi Act of 2002. And we'll get to know the contours of this market over the course of the presentation. Now, the sale of NPAs serves several purposes. One is, of course, that it mobilizes resources for banks. It transfers risk out of the banking sector. It hopefully leads to the market valuation of NPAs and incentivizes the infusion of capital for the reconstruction of the corporate debtor. The ARC has core competencies in debt collection, corporate restructuring, securitization, negotiated settlements, liquidation, etc. All these are functions that banks typically do not have core competencies in. Now, the there is a wide variety of cross-country experiences with the sale of NPAs to these entities, which in different jurisdictions are known by different names. Sometimes they are called asset reconstruction companies. In other places, they're called asset management companies, and so on. So in the late 1980s, there was a resolution trust corporation set up in the US. After the savings and loan crisis of the late 80s, there was Securum set up in Sweden. After the East Asian crisis, such entities sprung up in South Korea, Malaysia, Indonesia. Russia and India began their asset management / reconstruction companies in the early 2000s, China in 2012. These entities have had varying levels of success. Genuine markets for NPAs, by and large, do not exist. In the US, NPAs are transferred to a shadow banking system through largely over-the-counter transactions. In emerging economies, markets are hobbled by regulation, capital restraints, and moral hazard. The temptation of overpricing NPAs in order to make the bank balance sheet look good seems to be a temptation hard to resist. And this indeed is what we saw in the Chinese scheme, which has been operational since 2012, and which a World Bank report said shows a pattern of NPL transactions, non-performing loan transactions, concealing rather than resolving troubled bank assets. So basically, there's a pattern in which the NPL is sold at inflated values, and then everyone pretty much forgets about it. To put it rather starkly, and perhaps a little too dramatically. Now, if you look at the market trends in India, I've got data from 2007. The market trends in India are characterized by, okay, before I talk about this graph, let me mention that in India, under the Sarfazi Act, when an NPA, I'll be using NPA and NPL interchangeably. So when an NPA is sold in India, what happens is that the bank gets paid by the asset reconstruction company, and then the asset reconstruction company securitizes the NPA, and the bank has the option of buying into a certain proportion of those securities. So for all practical purposes, what happens is that there is a transaction which takes place at a certain deal value, and a certain proportion of that deal value is paid in cash, and the rest is paid in securities. So, so now in phase one of the market, which lasted from 2003 to about 2013, there was a very low proportion of cash involved in the payment made by the asset reconstruction company to the bank. So typically, the transactions, let's say you have an NPA with a net book value of 100 rupees, and it's sold at 25 rupees to the asset reconstruction companies. Of that, only 5 to 10% would be in cash, and the rest would be in the form of securities. So 5 to 10% is like 2.5 rupees or even lower is in cash, and the rest is in security receipts, which are held in the books of the bank. So that was, now of course, as far as the ARC is concerned, this is a really sweet deal, because they also got paid management fees for managing the security receipts held by the bank. So on a very low upfront investment, they were earning a sizable amount of management fees on the high security receipts held by high amount of security receipts held by the bank. So they were able to make hefty returns on investment without even lifting a finger when it came to the activity of reconstruction of the underlying asset. And after all, that was the main intention of the whole uh, asset reconstruction company. There's a reconstruction in that name after all. Now, so for the asset reconstruction company, this was, of course, a very sweet deal. The puzzle really is why banks went along with this scheme. And the model that I will present hopefully will shed some insight into that. The second phase of the market was from 2013 to about 2015. And in this
Rohit,
phase,
sorry to interrupt.
yeah,
Just some housekeeping. Yes, those of you who want to ask questions can please post their questions in the Q&A, and I will pose. I or Bala will pose them to Rohit whenever appropriate. Sorry to interrupt.
no, thank you. Thanks, Prashant. So the second phase of the market from 2013 to 2015, it saw a very high growth in terms of the volumes of NPAs which were sold. But again, cash proportions remained low, although a little higher than they were in phase one. And this second phase was really driven by the high generation of NPAs after the financial crisis of 2008. And since there were a lot of fresh NPAs in the books of banks, the banks would have had to make provisions for those NPAs. And selling the NPAs was a great way of avoiding those provisions. So, so there was a kind of an ulterior motive in the sale of NPAs which took place in this phase. And then once this fresh generation of NPAs slowed down, then we went into phase three, where there were a couple of regulatory changes. One was that the RBI mandated a phased progression to a 100% cash market over 2 years. So the market moved to 100% cash, and then the RBI also mandated what's called a Swiss challenge auction format for the sale of NPAs. Before this, a lot of the sales happened through negotiated settlements. So that was the phase three, and despite moving from a relatively low amount of cash to a very high amount of cash, the market continued to grow in phase three, and that really is also an interesting puzzle as to why it grew, and hopefully the model again will shed some light on that. As of now, if we were to look at the NPA market,
Rohit, just for clarification, what do you mean by cash here again?
Yeah. So suppose that we have an NPA with a net book value of 100 rupees, and the deal with the ARC is struck at 25 rupees, and the deal involves the ARC paying the bank 10% of the deal value in cash and 90% in securities.
I see.
Then the ARC will pay the bank 2 rupees 50 paisa in cash, and the remainder of the deal, which is 22 rupees 50 paisa, will be paid in the form of security receipts with a face value of 22.50.
Back to the bank, back to the original.
Yes, back to the bank, and it, yeah.
May I?
Yeah.
Yeah, one thing which is kind of striking is also the increase in the wedge. So one would have expected the discount on the NPAs that the ARCs are obtaining to have actually dwindled. As in one of the statements made by Rajneesh, SBI chairperson, SBI chairperson, was that the recovery rates have actually gone up after the IBC has been enacted. So in this particular chart, it seems that still the cash discount, the discounted cash which they're obtaining, is actually going. It's much. It's very low compared to the kind of asset size that has grown.
So Bala, I have to say that the diagram is maybe a little misleading, but you're right. The discounts haven't reduced significantly. They have more or less stayed the same.
Okay.
Yeah,
So
I
the
was wondering
haircuts,
about this as
yeah.
well, Bala, but I guess, I mean, on the y-axis, we have currencies. So it's difficult to, I was going to ask whether this discount has remained stable over time or has it really increased?
So if
Uh,
it is
you know,
100% cash, then essentially that is a recovery rate, right? So on a
100%.
100, yeah, on a 100 rupee of NPAs, if you're getting say 25 bucks from the ARC, then 25% is a recovery rate, 75% haircut. So essentially the last part of your chart is kind of capturing the recovery for the banks, isn't it?
Yeah, actually, this is capturing not just the cash recovery, but the deal value, which would also be the face value of the security receipts.
Securities, yeah. Yeah, so typically, like in real estate, for example, such distressed assets would sell at a discount of around, 30 to 40%. So 75% seems quite high. And I was wondering
Yeah.
if
No, let me show you the data. Let me show you
Mhm.
some data. It's not as high as 75%. It's about 66%. So
66%.
if we were to look at the average discount rate, it's about 66%
Hmm.
on a book value of assets acquired about 5.3 lakh crores.
Hmm.
And as far as the redemption is concerned, again, you see, you acquire a 100 rupee net book value at about 34 rupees, but you are only able to redeem about 66% of that. So you are ultimately only, yeah. So your redemption rates,
66% of the 40%, you mean, of the 34%.
yes, yes.
And where does the remaining go? It's quite
It's
interesting.
not it's not redeemed. It's not the face value. Maybe let's say that you've got a net book value of 100 rupees,
Mhm.
and you just to keep things simple, let's say your deal value is 30 rupees, right? Of which let's say 20% is cash. So that would be 6 rupees, and 24 rupees is the face value of security receipts,
Securities. Hmm.
right? Now, on that 24 rupees, right, you are going to only get 66% of that. So you're going to get 16 rupees.
Hmm. Hmm.
Okay, so not just is the discount rate high, in other words, the deal value, not just is the deal value low,
But the
but even on
redemption of the
that low
security.
deal value, there is a subpar redemption rate.
Hmm. Okay.
Okay, so
So
uh,
perhaps you will come back to this
yeah,
later in your
yeah,
research.
yeah.
But as the ARC market, because as of now, it appears to be quite attractive. I mean, you're acquiring distressed assets, but at a heavily discounted price. On the top of that, you're also earning fees. Uh, so that means that there would be more competition coming in this market, and that may help shrink the discount over time,
You
right?
see, the short answer to that, Prashant, is that the attractiveness of this market depends on the regulations in place to allow the infusion of capital to reconstruct the corporate debtor.
I see. Hmm.
And those there are fairly stringent regulations in place which prevent that flow of capital from happening very smoothly.
Okay.
Uh, so I'm not really going to go into those regulations. I'm really more focusing on the model in this stock. But we can, I mean, there are such regulations.
Sure. And audience, if you have any questions.
For example, one of the regulations is that let's say a deal has been struck at 30 rupees. So the ARC is only allowed to bring in 25% of the deal value as capital.
I see.
Okay, so those are the kinds of regulations which prevent this market from really taking off. So the ARC committee has made a whole host of recommendations in order to try and make it easier for capital to come in.
And the rest has to be securities. Is that what you're saying? So
no. See, even when the sorry, I didn't understand the question. Basically, the capital which comes in, even they become holders of securities in this ARC trust.
Okay.
Okay.
So,
Yeah. Even that. So the existing security holders get diluted. Okay. So I have already spoken about these regulatory phases. So I'll just flash these slides. You can take a look at it. The interesting thing is that after 2016, there was a move to a cash-only market, and a Swiss challenge was mandated. A Swiss challenge auction is used for infrastructure projects in Europe, where if there is a party, a private player, which puts in a bid to build some infrastructure for the government opens up the market to challenges by other private players, saying these are the specifications these are the specifications of the project, and we have a certain bid which has been placed by a service provider, and the market is open for other bids. So that's what the Swiss challenge is, and the person who makes the lowest bid obviously wins the auction and gets the project. So that's what a Swiss challenge is, and so that was the method which was mandated. Suppose an asset reconstruction company makes a bid for a certain NPA held by a bank. The bank will then have to announce the bid and will have to receive counter bids from others, and the one who ultimately ends up with the highest bid will win the auction. And there are certain rights of first refusal, etc., involved as well. Okay, so the third change which was made in 2016 was quite significant. The RBI allowed the ARCs to partner with funds and other NBFCs in order to bring in capital, because ARCs would have had a really tough time when the market moved to a cash only kind of a model. So they allowed the ARCs to partner with funds and NBFCs in order to ease their capital constraint. Now, when I want to make something clear, when we say that the RBI moved the market moved to a cash-only model, it happened not as a mandate, but it happened in the following way, that the RBI said that if you have less than 90% cash in the mode of payment, then we will treat the NPA as continuing on your books. And you will have to continue to provision for the NPA, for the portion of the NPA against which you are holding security receipts. Okay, so if you did not have at least 90% cash in the mode of payment, if the ARC did not pay you at least 90% in cash, right? So again, coming back to that example, 100% net book value, 30 rupees deal value, let's say you have 89% is your cash component. So 89% is about 26 rupees, let's say. So the bank gets 26 rupees in cash, and 4 rupees it holds in the face value, in the form of face value of security receipts. Now, those security receipts will not be treated as an investment of the bank, but will be treated as an NPA, which the bank continues to hold and for which the bank needs to continue to provide provisioning. Okay, so that was the way in which the incentives were created to move to at least 90% cash. And once the 90% cash was implemented, then the market pretty much, went to the extreme of 100% cash. Now, so let's now cut to the model.
So in a way, you can get rid of those NPAs, write them off, but the stigma will stay on the balance sheet, right?
Yeah, the stigma will stay. Yeah, the stigma will stay on the balance sheet, and we will have to continue to make provisions.
Mm-hmm. Mm-hmm.
Yeah, I mean, earlier with less cash, it was just, a shift from advances to investments. That's
Yes.
the only difference. It's in the same books at a discounted
Yes.
price. So it's the same asset, the bad assets.
Yes, yes, Prashant, that's exactly right. So they moved from advances to investments, but they got away with it because they didn't have to make provisions for the security receipts component of the deal. But now they would have to make provisions for the security receipts component and treat them as if they were still NPAs.
So
maybe not. Sorry, Prashant, go ahead.
Sayak Chakrabarti is asking a question. I hope Sayak is not a trick question. It's a difficult question to answer, but he says that NPA problem in India is high. That makes investors nervous. So what should the bank do to reduce this kind of NPA problem?
Thank you for the question. They should try and create a well-functioning NPA market, and that's what I hope to talk about in the remainder of the talk.
Mm-hmm.
So, I mean, besides that, there is a whole host of things which can be done apart from the market design part of things. From this loan sale platform, which is now being created, which Prashant and I were talking about, to something as simple as publishing, making it known to the asset reconstruction companies, publishing a kind of a list of NPAs which are more than 2 years old, so that the asset reconstruction companies know what are the NPAs for which they might place bids. Today, there is, even that information is not available to asset reconstruction companies. Okay, so that's one recommendation that we've made.
But may I ask you one question there?
Bala, let me just continue. I understand there are
sure.
sensitivities involved with making this list public and all that, but we can talk about that later. So
it's if I may, it's not on the list per se. But just one question, because when we say you went to a cash market, is there a chance that the price discovery is affected? Because let's say that price discovery is affected. I'm an ARC, and I'm actually bidding for this particular asset. I know it's a distressed asset, so valuation is tough. So then, if I'm
sorry, Bala, your voice is not very clear. It's breaking.
Oh, is it? I'm really sorry about that.
It's better now. Yeah, could you please repeat your question?
Yeah, the question is once you shift to 100% cash market, then from an ARC's perspective, I might be. I mean, there is a kind of dissonance in terms of the valuation that I'm attaching towards a distressed asset. So earlier, when the bank was supposed to take or partake in this process by investing into security, there is some risk, mitigation as far as ARC is concerned, because part of the risk is borne by the bank, right? So now, has it played up to the discounts that now you'll be wary of, quoting high bids for these particular assets?
Yeah, absolutely correct, Bala, and that's what we are going to be talking about in the gains to trade model. So please take my word for it and just give me another 5-10 minutes. So the last thing I would say about the market as a whole, before jumping into the market design aspect of it, is that there are certain small changes which need to be made. For example, there is a secondaries market for these securities, right? Which the NPA is sold to the asset reconstruction company, which sets up a trust, securitizes the NPA, and there is a secondary market. So the list of qualified buyers in that secondary market is limited right now. So as a result of which the secondary market doesn't function that well. Another reason it doesn't function that well is that the ratings of these securities are, the process of ratings is not a very fair or transparent one, right? Because of the classic problem that the rating agencies are paid by the asset reconstruction companies. Asset reconstruction companies do rating shopping and frequently change their rating agency and so on. So those are the kinds of things, small and big, which need to be fixed. But let's move right into the gains to trade model, if I may. Now, the puzzles for market design. Okay, let me jog your curiosity by starting off with by giving you some puzzles. If you look at the objectives of the NPA loan market, right? What do you want to achieve with that market? One is that you want to achieve a high upfront investment, right? So you want there to be a high upfront investment so that the bank can get access to capital, its books can start looking better, it can start making loans. You want a high cash proportion. The deal should be mainly in cash, or there should be a large percentage of cash so that a lot of the risk gets transferred out of the bank. Okay. You want the asset reconstruction company to have strong incentives for engaging in reconstruction and corporate revival. You want the market to be efficient, whatever we mean by that, and you want the market to discover a fair value for the NPA. These are some of the objectives. There may be others. Now, the interesting thing is that there is a lot of tension. There are tensions between pairs of these objectives. For example, there is a tension between a high cash proportion and discovery of fair value. For the reason that Bala was mentioning, if we have a very high cash proportion mandated in the deal, then we are unlikely to discover fair value for the NPA. We probably go below the fair value. Okay. There is a tension between high upfront investment, which means the actual amount of cash, the amount, not just the proportion, the amount of cash that the bank gets for an NPA sale, and high cash proportion. Now, this is something that should jog your curiosity. How can there be, so isn't it true that if you have a higher proportion of cash, you should also simultaneously have a higher amount of cash involved? The answer is no. Okay, we will see that actually the highest upfront investments are possible at fairly low cash proportions. Okay, there is also a tension between market efficiency and the ARC's reconstruction incentive. Let's see why. You see, the asset reconstruction company has a higher cost of capital than the bank. Okay, and therefore there is what is called an interest rate wedge between the seller of the NPA, the bank, and the buyer of the NPA, the ARC. And this interest rate wedge creates inefficiency in the market. So how do we minimize this inefficiency? By reducing the cash component of the deal, right? And allowing the payment to be made largely in securities so that the bank gets very little cash and mostly ends up holding securities where it was earlier holding an asset in its balance sheet, an NPA in its balance sheet. Okay, but if we minimize inefficiency or we maximize efficiency by reducing the ARC's cash exposure, then we must also recognize that the ARC's incentive to engage in reconstruction also gets minimized. And so there's a tension between market efficiency and the ARC's reconstruction incentive, right? And of course, this whole business of management fees is a controversial one. The outsized returns which were possible for ARCs to make without lifting a finger as far as reconstruction was concerned in the early years of the ARC market created a lot of controversy. Do management fees actually play a constructive role in this market? With these puzzles in mind, let's move into the brass tacks of the model. Okay, what I'm going to do is that any successful market is based on facilitating a large number of transactions. A transaction is possible when the seller and buyer are both incentivized to transact. That is, there are gains to trade, right? So what we do is we have a two-staged approach. First, we identify feasible trades between the bank and the ARC for different combinations of cash proportion and deal value. Okay, so we identify all the feasible trades which exist in the market, and then we use the analysis of this feasible trade set to formulate design principles for the NPA market. Okay, we'll segue into that part of it, into market design. Now, so first of all, we identify feasible combinations of deal value and cash proportion for the bank. Then we do it for the ARC. Then we bring these two portions of the analysis together to look at what are the feasible combinations of deal value and cash proportion in the market. And then we also bring in this concept of true value or fair value transactions, where we say, of these feasible transactions, how many of those feasible transactions are taking place at or above true value? So that's how we go about the gains to trade portion of it. Now, the actual process of this ARC market is fairly complicated, and I'm just going to flash this slide to show you how complicated it is, but thankfully I'm not going to spend much time on it. What I'm going to, the model process is as follows. There's a corporate debtor, let's say an SR, a steel, which has borrowed money from a bank, which is the asset of the bank. The loan asset of the bank has now turned into a bad loan. And now the bank has the option of either engaging in a process of internal restructuring, or it can go to the IBC process, either formally in the IBC process or through the pre-pack, or the bank can sell the NPA to the asset reconstruction company. So when the bank is making its decision, it is comparing the return it could get from internal restructuring / IBC with the return that it could get from the ARC. Okay, let's see how that looks in terms of modeling. It's fairly simple. The bank sells the NPA to the ARC and gets cash and security receipts in return. Okay, the valuation of the let's say that the deal value is denoted by V, and I'll do a numerical example just after this slide, so don't worry, it'll become clear then. So let's say V is the deal value, K is the cash proportion. So the amount of cash that the bank gets is KV. Okay. Now the face value of the security receipts component of the deal is the face value is 1 minus K times V, right? Obviously. But we say that the bank doesn't value the security receipts at the face value. Okay, it has its own estimate of fair value, okay, which we call T, and we say that the bank values its security receipts at T times 1 minus K, right? Where T, as I said, is the bank's estimate of fair value. As I said, just give me a minute and we'll come to a numerical example. Okay. Now, I know the question that you have in your mind is how come, if there is a true value, how come there can be a deal which is not at true value? How can there be a deal value which is different from true value? All those things hopefully should become clear. Now, the aggregate management fees due is the management fees is assessed on the face value of the security receipts. The face value of the security receipts is 1 minus K times B, and we say that the aggregate management fees due is 1 minus K times B times F. Okay, and we assume that K, V, okay, the alternate to the ARC, as I said, is the IBC / internal restructuring process, and we say that the returns from this alternate process are denoted by SI, where S is surplus, I is IBC. Okay, I know it's a little awkward, the notation, but pardon me that, indulge me. So, so SI is the alternate, return that the bank could go by, or the reservation value that the bank has if it doesn't go to the ARC.
So
F is the
S1 is value, not return, right?
Yeah, it's value. It's value.
Okay.
It's value. Yeah. F is the management fees. T is the true value. We assume all of these are between 0 and 1, and we assume that the true value is greater than the expected return from the IBC/internal restructuring. We assume that the ARC indeed adds value to its reconstruction core competency. Okay, so what would be the perceived value of the bank? Okay, the perceived value of the bank would be the cash component plus its valuation of the security receipts it holds minus its dues in terms of management fees. Okay, so its true value would be something, would just be KV, which is the cash component, 1 minus K times T. It's not TB, pardon me, this is some residual notation. 1 minus K times T, which is the bank's valuation of the security receipts it holds, minus the management fees that it pays, 1 minus K times V times F. Okay, and the transaction is feasible if B, which is the value of the bank, is greater than its reservation value, which it could get through internal restructuring or by sale to by participating in the IBC process, which is SI. Okay, so let's jump into the numerical example. The numerical example is as follows. Let's say there's a net book value of 100 rupees, deal value of 40, of which 16 is in cash. So there's 40% is the cash component. So 16 is in cash. 24 rupees is the face value of security receipts. 16 plus 24 is 40. So with the book, so far we are all okay. Now let's say the bank's estimate of true value is 35. Okay. Now, so and let's say the management fees is 10% and the IBC proceeds are 25. Right. Now, what is the perceived value of the bank B? 16, which is cash, plus 60% of the bank's estimate of true value, which is 35. Okay, so 60% of 35 minus 10% of the face value of the security receipts held, which is 24. Okay, so the bank's perceived value from selling an NPA to the ARC is 16 plus 21, which is the bank's estimate of the true value of the security receipts it holds, which have a face value of 24, but the bank says no, it's actually worth just 21 because the bank's estimate of true value is less than the deal value. 35 is less than 40, minus 2.4, which is the management fees paid by the bank, right? So it's 34.6. This is greater than the IBC proceeds of 25, so the transaction is feasible. If the IBC proceeds, were 36 instead of 25, then the transaction would have been infeasible, unless, of course, the cash proportion of the deal increased.
So, Rohit, quick question.
Yeah.
So the 35 true value of the securities, this must have already included assumptions about loss severity. So where does this additional 60% come from?
This
You're
is
further
merely
discounting it by
60,
40%.
No, this is not discounting, Prashant. This is merely the fact that you are already got 40% in cash. So we have to forget about that. We have to talk about the 60% of the NPA which you are holding in the form of securities.
I see.
Right.
So 35 is SI here.
No, 35 is T. T
35
for
is T.
T for true value.
Why does the true value and the deal value diverge?
Okay, that we'll come to that, Bala. We'll come to that. That actually is the whole meat of this model.
Okay.
Okay.
Okay. So now that is the now let's just put some algebra on this. Again, if we were to look at what we are saying that B minus SI must be greater than equal to 0. What is B? B is KV plus 1 minus K times T, which is the bank's estimate of the true value of the securities it holds, minus 1 minus K times VF, which is the bank's due as far as management fees are concerned, right? So it becomes, and minus SI must be greater than or equal to 0. This is the bank's equation. This equation is satisfied if and only if equation 1 prime is satisfied, okay, which gives us a threshold value of a threshold deal value at which the bank would be willing to transact, VB, right? Now, this VB could be an upper or a lower bound depending on whether the coefficient of V in equation 1 prime is positive or negative, right? If it's positive, then VB is a lower bound. The bank will only carry out the transaction if the deal value V is greater than VB. But if 1 plus F times K minus F, the coefficient of V in equation 1 prime is negative, then VB represents an upper bound. Okay, the bank will only carry out the transaction if the deal value is lower than a certain amount. Now, this is a very peculiar thing that I'm feature of this model, right? And I'm going to explain why this feature occurs again in a minute. Okay. The graph of the threshold deal value can be categorized into two cases. But before that, let's talk about the anomalies of the model. Okay. The anomalies of the model are, one is that when the deal is carried out at low cash proportion, in other words, the bank is getting paid mainly in the form of security receipts, then the bank has to pay management fees on a sizable holding of security receipts, right? So the management fees becomes uppermost in the calculations of the bank. And the higher the deal value, the higher the management fees. Therefore, the bank is interested in limiting its management fees. And therefore, in placing an upper bound on the deal value. In fact, the lower the deal value, the better. Okay, so this is one anomaly in the bank's incentive. Second anomaly is that typically one believes that a bank would prefer more cash to less cash. But when deal values are much lower than the true value, right, then the bank prefers to hold securities despite the management fees rather than cash, right? When the bank is getting a deal value which is much lower than true value, the bank says, why should I hold cash? I prefer to hold securities because the securities are going to give me the true value, which is much greater than the deal value, right? So the bank prefers lower cash proportions to higher cash proportions. Okay, and these two anomalies have to be addressed in the market design. Okay, so now some pictures. The graph, so what we are now going to do is we are going to draw graphs of the threshold deal value of the bank versus the cash proportion. Okay, that's all we're going to do now. Okay, and there are going to be various cases that we're going to discuss. So the cases can broadly be divided into two kinds. One is where the true value is significantly higher than the IBC proceeds. Where, okay, now, and when I say significantly higher, this is the equation which actually indicates what I mean precisely by significantly higher. When T is greater than SI 1 plus F, SI being the IBC proceeds, F being the management fee. Okay, when true value is significantly higher, we get one kind of graph, and when the true value is not significantly higher, we get another kind of graph. Okay, so let's see what those graphs look like. Yeah. Okay, so when the true value is significantly higher, then this is what the graph looks like. Okay, this pink on the x-axis is the cash proportion, on the y-axis is the threshold deal value, and the red, the red hyperbolic sections um, represent the graph of VB, the threshold deal value. Okay, now in in this section of the graph, the threshold deal value is a lower bound. The bank will transact if the deal value is higher than the deal value indicated by this graph. In this section of the graph, the deal value is an upper bound. The bank will transact only if the deal value is lower than the values indicated by this graph. Okay? In fact, when the cash proportion is greater than f by 1 plus f, then the bank's surplus is increasing in deal value. But when the cash proportion is less than f by 1 plus f, the bank's surplus is decreasing in deal value. Okay. Now, the true value, okay, is indicated by this particular horizontal line. So what you can see is that it's feasible to carry out a true value transaction at all cash proportions from 0 to 1, right? And indeed, the feasible set is a very large one, and it includes all cash proportions from 0 to 1, and it includes a wide variety of deal values starting from SI, when the cash proportion is 100%, which is the IBC proceeds, and going to infinity. Okay, when the cash proportion is f by 1 plus f. Yeah.
Sorry to interject. So if you go back to your equation, when cash proportion is actually 100%, the limit is SI.
Yeah, let's go back to the equation. Yeah. So when you get the when the cash proportion is 100% in this equation, that means k is 1, then you get v must be greater than or equal to
in your threshold, the second equation, if you put k equal to 1, it goes to VB is equal to SI, right?
Yeah, that's right.
That is the current scenario, right? If the government, if the RBI is mandating 100%, you're saying that the value that they're getting is only as good as what they would have got if they went to IBC.
No, what I'm saying is that the value that they must get at a minimum is what they would get by going to IBC, because in IBC also they get 100% cash. So at least you must, if you're getting, you must get at least what you get in IBC or higher in order to transact. Is that clear, Ala? Okay. So this is the graph, but this is the most optimistic scenario. A variation of this is when where this red line on the left, which I'll again show you. On the left, this red line, if you remember, was above the horizontal line indicating true value. Now, if it goes below that horizontal line, then what happens is that in order to, your feasible set gets, reduced. And in order to carry out a true value transaction, you need to have a minimum cash proportion of KTB. And of course, any cash proportion from KTB to 1 will be consistent with a true value transaction. But if you're below KTB, then then you can't do a true value transaction, because your VB is an upper bound, and this red line indicates that you won't go beyond this point. You won't go up till T. You will stay maximum deal value that the bank is willing to take is shown by this red line here, which is everywhere less than the true value when K is less than KTB. Okay, so this is the second case. Now, in both these cases, the true value was significantly higher than the IBC proceeds. But what if the true value is not significantly higher than IBC proceeds? What then? Is there still a feasible transaction with the ARC that the bank might be interested in? And here you see that here the graph starts looking quite different. The graph earlier they were upward sloping hyperbolic sections, and here you've got downward sloping hyperbolic sections. What is the constant is that in both graphs, to the right of k equals to f by 1 plus f, you're seeing lower bounds, and to the left you're seeing upper bounds. Okay, so the feasible set is indicated by the hatched area, and you can see that you can do a true value transaction only if the cash proportion is greater than KTB, and this KTB is higher than f by 1 plus f. So earlier on also we said that there was a restricted set of cash proportions at which true value transactions were possible, but here that set gets restricted even further. But it's interesting to note that true value transactions can still be supported by the market. Okay, so now if you were to look at rough estimates of parameter values in India, if we were to say that on IBC you're getting about 30 paisa to the rupee, or 30 rupees to 100 rupees, and if you say that the true value is about 32 paisa to the rupee, and management fees is about 10%, then we would fall into case 2. And this is the diagram that you would be looking at. And I can answer one of the interesting aspects of the market straight away. If you remember, in the early years of the market, transactions happened at very low cash proportions. And we said that was quite understandable from the ERC's point of view, but we didn't really quite understand why the bank would be willing to undertake those transactions. And this graph tells you why that might have been possible. You see, at a cash proportion less than f by 1 plus f, which would be roughly about 10%, the bank actually doesn't want very high deal values. The lower the deal value, the better for the bank. Okay, and that's why the bank was willing to carry out transactions at very low cash proportions and very low deal values from 2003 to about 2013. Okay, so let's move to the decision of the ARC. Now the ARC is comparing the rate of return on the capital deployed in the transaction, that is the cash component of the deal, with its cost of capital. The return on investment comes in two forms. One is the risk-weighted returns on security receipts held in the ARC's own name. So remember that if you have a transaction in which there's 30% cash and 70% security receipts, then we, in that trust created by the ARC is holding 30% of the security receipts, and the bank is holding 70% of the security receipts. So there is 30% of the security receipts being held by the ARC. So that's one form in which the return on investment comes. And the second is the management fees earned by the ARC for the security receipts held in the name of the bank. Okay, the security valuation of the security receipts component held in the ARC's own name is K times T, where T is the risk-weighted net present value of the NPA. Now, in this model, simplified version of the model, I have assumed that the fair value as per the bank and the ARC, these two fair values are the same. Okay, in a more elaborate model, you could have TB, where TB is the fair value as per the bank and TA is the fair value as per the ARC. Now, the management fees, as we said earlier, is 1 minus K times VF. The capital deployed is KV. We assume that K, V, T, and F are less than 1. And so the ARC's equation looks as follows. Okay, the money deployed is K times V, the capital deployed. Now, K times T is the ARC's estimate of the value of the securities held in its own name, and 1 minus K times VF is the value of the management fees which the ARC expects to earn. And so the return that the ARC gets is shown by this particular equation, and we can simplify it to get this form. T by V plus 1 minus K by K times F. Okay. Now, immediately you can see something pretty interesting. You see K here in the denominator. And so you can see that the returns to the ARC can go to infinity as K becomes smaller and smaller, right? So, but the actual equation of the ARC is shown in equation 2 here, that the net return, net of the cost of capital must be greater than 0. So this is the equation of the ARC. And this gives us a threshold value, deal value, which the ARC, for the ARC as a function of the cash proportion. And here the threshold value is always an upper bound. So here we don't have the kind of anomaly that we saw in the case of the bank's threshold equation. Okay. So what does this graph look like? Well, this graph looks like this blue graph here. This is the graph of the ARC. Sorry, this blue graph here, and you can see at 100% cash proportion, the ARC can only dole out T by Z, where T is the true value, Z is the cost of capital. But if the cash proportion is F by Z plus F, the ARC is willing to give you an infinitely high deal value. Right now, we could also ask the question, what about the upfront investment? Because sometimes, in a risk-averse market, all that banks and regulators and vigilance is looking at is how much is the cash that the bank is getting for the NPA, right? So this green graph shows you the amount of cash that you get in the market, and it is a fairly interesting graph as at very low deal values, at very low cash proportions, you get very high amounts of upfront cash. Okay, even though the cash proportion is low, but the deal value, the deal value that the ARC is willing to go up to is so high that the amount of cash you get is really high. But then it starts reducing. And it reaches a minimum somewhere below, it reaches a minimum at some point and then starts increasing all the way to T by Z when the cash proportion equals 100%. Okay, so this is what the upfront investment looks like as a function of the cash proportion of the deal. And again, if we were to go back to the equation that we looked at for the threshold deal value, what I could do is in this equation, I could say, instead of VA, I could just put T, and that would give me the cash proportion at which the ARC is willing to carry out a transaction at a deal value which is equal to the true value, the fair value. Okay, so that will give us a cash proportion which is F by Z plus F minus 1, which is over here. And so now notice that at any cash proportion above F by Z plus F minus 1, the maximum amount the ARC is willing to pay is lower than the true value. Okay, and I think, Bala, you will be getting some answers to your question that you posed earlier. Okay, and at cash proportions less than F by Z plus 1, the ARC is willing to do transactions at deal values higher than the true value because of the disproportionate returns it's getting through its management fees. Okay, right. Now, this diagram, just one point, if I may, this diagram is accurate in the sense that under very plausible assumptions, the minimum of the upfront investment is reached at a cash proportion which is lower than the threshold cash proportion associated with a true value transaction. Okay, so if I was to just, yeah, so you see this particular point at which the minimum of the upfront investment is reached is always to the left of the cash proportion at which you achieve a true value transaction. So that's not something that is misrepresented in the diagram. Sorry, there was a question.
Yeah, one of the assumptions that you have made in the model is that the bank and the ARC, they have arm's length, right? They are completely, totally different entities. But in India, we can see a lot of ARCs are actually bank finance or other capital comes from the banks. It is joined at the hip. Now, in that case, the model could, I mean, see, the incentive for the bank
Yeah,
is to
yeah,
show
yeah, yeah.
cash
No, I see what you're saying. I see what
or
you're
a
saying, Bala.
consortium of banks, So there is an interest, there's an incentive for the banks to show that they have actually got a higher proportion of recoveries from their sale of NPAs. And
Yeah,
these ARCs are in turn owned by the banks themselves, right?
yeah,
So then
yeah.
the model, yeah.
Yeah. So thank you for that question. So, I'm sure you're thinking of RSIL, which is owned by State Bank, partly owned by State Bank, or, sizably owned by State Bank of India and so on. And certainly the model will need to be tweaked in that case. And there are certain qualitative differences which will arise. Indeed, when we come to the National Bad Bank, which is owned by the banks, right, and which is a kind of a public sector ARC, then a whole different calculus comes into play. A whole different set of considerations comes into play. So you're right that this model doesn't capture those considerations, but there are a large number of ARCs in the Indian market.
Only down,
privately
again
owned.
coming back to the point that if 100% cash is mandated, right, then the incentive for the ARC to quote a higher price is lower. I mean, for them to get a fair bid.
Yes.
So then it's like a lose-lose for all the parties in terms of.
Yes,
so
exactly.
Then there is an incentive for the banks to in turn be the ARCs, to actually fetch more value.
I agree with you, Bala, entirely. And in fact, one of the recommendations of this model is that we should move away from a 100% cash market. Okay, that is one of the big sort of slogans or the punchlines of this presentation. Okay,
so in a way that helps reduce some agency problems as well. In fact, some of the audience have been pointing at the same issue here. Riddhi Vayeda and Mubarak Ali are asking about the bad bank, and I guess the bad bank.
I will come to the bad bank. I will come to the bad bank.
Mm-hmm.
Okay, I will come to the bad bank if I'm yeah.
So we have perhaps 5 minutes, Rohit. It's a very interesting presentation, but yeah,
oh
we
man,
have to wrap up. Yeah,
Prashant, I thought I had till 8:30. Okay, all right. So I'll move quickly. I'm sorry. So now if I so now to answer the question of Bala and some others, you see, as Bala has been saying, if we move to 100% cash market, the ARC is not willing to give you true value because it has a high cost of capital. So if we are moving to a 100% cash market, we must be doing transactions at less than true value. Or we may be dealing with entities whose cost of capital is different from the entities that our model has so far been dealing with. Okay, so actually that is what has happened. If you look at the data, after the RBI allowed foreign investors to come in, the foreign investors are now making the lion's share of investment. Okay, the gray portion is the foreign investors. Okay, so these other investors have become very important in the market, but we can do better. Okay, what I'm going to do in the remainder of the talk is very simple. I'm going to bring together the diagrams of the bank and the ARC, and then look at the intersection of the feasible sets, right, to see what is feasible in the market as a whole. Okay, and then that will give you all kinds of combinations. And the punchlines are given in these two slides. When the true value of the NPA is higher than IBC proceeds, then there is a large range of cash proportions and deal values which yield feasible transactions, as well as a large range of cash proportions yielding true value transactions. Okay, so this is a fairly easy market to design. What we want to do in this market is we want both the cash proportion and the deal value to emerge endogenously from the process of bidding. Okay, because there's a whole set of possibilities, so we really don't want to restrict things except to avoid the anomalies which I spoke about in the case of the bank's incentives. Okay, we need to make sure that the cash proportion is higher than a certain amount, and the deal value, minimum deal value, is higher than the certain amount, in order to make sure that the bank's incentive or the bank's utility function, if I may call it that, is not anomalous. Okay, but apart from that, we should not be bothered. But when the true value of the NPA is not much higher than the IBC proceeds, which is case 2, there is a relatively limited set of cash proportions and deal values which yield feasible transactions, within which there is a subset of true value transactions. Okay, and in both cases, there's an upper bound on cash proportion beyond which no true value transaction is possible. And this is an upper bound which is determined by the ARC's incentive, which we saw in the ARC's diagrams. Okay, so if you want to do true value transactions, you cannot mandate 100% cash. You have to take into consideration the fact that the ARC, because of its high cost of capital, is not going to be able to do those transactions at deal values which are equal to true value. In case 2, there is also a possibility, there is also a lower bound on cash proportion below which a true value transaction is not possible. And so it is, in case 2, it's possible that no true value transactions are possible. So with this, I would like to, just show you one interesting graph, which is this one, or even, which basically says that, assuming that the market conforms to case 2, the phase 1 of the market is probably explained by this area of the feasible set. Phase 2 is explained by this area, which is not part of the feasible set at all. But transactions took place because the banks had fresh NPAs on which they would have had to set aside capital for provisioning, and they avoided that by basically palming off the NPAs to the ARCs and showing them as investments, and washing their hands of the whole affair. And phase 3, where we have 100% cash, might be indicated by this area, although, as I said, it's probably the participation of foreign investors that allows this market to continue to function at moderate levels of growth. So this is the market analysis which I wanted to share. There is an interesting case where, as I said, in case 2, the return of the true value is not significantly higher than ABC proceeds, and the cost of capital is so high that the discounted true value is less than the IBC proceeds, and yet you can do a true value transaction provided that the P by Z is not too much lower than SI. Okay, which actually this is all the magic of the management fees in the market. Okay. It's the management fees which is playing a very important role in the market. Remember, you don't want the ARC to take too much exposure, because the ARC has a higher cost of capital, and that high cost of capital actually creates an interest rate wedge and reduces the efficiency of the market. So, but if you reduce the exposure of the ARC, you're also simultaneously reducing the incentive of the ARC to engage in reconstruction. So you restore that incentive through the management fee. Okay, so the management fee plays a very important role in this market, although of course it has to be, it should not be too high, because ideally what we want is that the market should function in the region of case 1, where T is greater than SI times 1 plus F. Okay, so so there has to be a balance which has to be struck here, and of course, the one thing, we could look at a variation of the model in which the bank is very conservative. It says, look, the security receipts, whatever the deal value may be, or whatever the true value that the ARC is plugging, I'm going to say that the value of the security receipts is going to be assessed on the basis of the internal reconstruction that the bank could carry out, or the ABC or the IBC returns, whichever is higher. So the bank could take a very conservative view on its utility function. And it could also say that, look, I will only do the transaction if, and I will only pay you management fees, not on the face value of the security receipts I hold, but on my assessment of on what is the true value of the security receipts, which is again based on the IBC proceeds or the internal restructuring activities of the bank. The bank could take a very conservative position, in which case the whole market comes to a grinding halt. Okay, if the no transaction would be possible if T by Z is less than SI. And so for this market to function, but this market should function because actually the ARC is bringing positive value through reconstruction. T is indeed greater than SI. So here accounting gains would play a key enabling role to facilitate transactions. In other words, if once the bank actually sells the NPA, even though it may hold 60, 50% or 40% in the form of SRs, it should be deemed to have left the books of the bank. The NPA should have been deemed to have left the books of the bank, and it's the accounting gains that the bank stands to make that would play an enabling role in making transactions happen in this scenario. Okay, I will at this point just end with the details of market design. What we are saying is that there should be a two-dimensional bidding procedure in which the ARCs mention their cash proportion as well as the deal value. And then there should be a publicly announced conversion function to convert the two-dimensional bid into a cash equivalent. And we don't want to be too prescriptive here. Different banks may have different conversion functions. We do want to set certain reserve prices in terms of both the cash proportion and the deal value. And the setting of this reserve price is really determined mainly by the consideration that the bank's surplus function should not behave in an anomalous manner, right? So the bank surplus function should be a positive. It should be a positive function of the cash proportion as well as of the deal value. Okay, so that's what that's the consideration which plays. That's the consideration playing here, and then we want the market really to be able to achieve true value bids. So we may want to set the minimum cash proportion close to KTA, which is the maximum cash proportion, which is consistent with the true value transaction. So if we want to be, if we want to be a little more prescriptive, or if we want to, if we want to be a little more controlling, if I may call it that, we can set the minimum cash proportion closer to KTA. So I've given an example: SI 0.3, T is 0.33, F is 0.15, Z is 1.2. The minimum cash proportion consistent with the true value transaction is 0.4. Maximum cash proportion is 0.43. So we could set so basically a true value transaction will happen between 0.4 and 0.43, and we can set a minimum cash proportion around 35. So now this is really hand waving. This is heuristics. There's no science involved here. Now, management fees.
So, Rohit, sorry, I lost you at some places in the derivation. Yeah. I wish we had read the paper in advance. But no. Do these calculations require an estimate of the true value as well?
Interestingly, yes, KTB does, but not KTA.
Not KTA. So that itself is a contentious point, right? Because there you would need some kind of an empirical model on which all the players agree, right? From the policymaker to the bank who is signing a deal with an ARC, as well as the ARC. On the top of that, right?
So the bank, you see, this is actually the auction designer is the bank. So the bank is calling the shots. The bank has its estimate of true value, which may be different from the estimate of true value of the ARC. So the bank will set the parameters of the auction based on its own parameters.
Yeah, and then in this dual bidding, uh, at some point the bank will have to defend its choice of T, right?
It will have to defend its choice of T. It will have to defend the schedule which it publishes, saying that this combination of cash proportion and deal value corresponds to this net figure.
Mm-hmm.
Okay, so
Mm-hmm.
that it can rank different bids.
Mm-hmm.
I actually talked to bankers in the ARC committee, and I recommended a certain conversion function, but I got tremendous pushback saying that we do not want any prescriptions of this kind. We will deal with it based on our own internal processes and our own
No, I think this is
constraints.
this is a promising proposition, and that pushback is of course natural, right? Because this is now it's a two-dimensional decision. It's not linear. It's difficult for all the parties to comprehend unless it's made accessible through various talks or white papers.
True.
But Rohit, I'm sorry.
Yeah.
This has been a very engaging presentation, but it's 8:30 here, and for many of our friends abroad, it's
Okay.
perhaps an even odder time. This was a wonderful presentation. Bala, would you like to sum up? Would you like to say something? Or
Yeah, I mean, again, engaging and very thought-provoking, actually. So, uh, I mean, there are a lot of points that you have mentioned out here. I think it's an evolving market, and it's very much required for India per se, because I typically tell my students that at least in the front end, the security side, we are quite way ahead in terms of having regulations and minority investor protection. But the creditor rights is where we are actually lagging behind. The markets for recoveries and the loss rates are quite high. While the World Bank report says we have actually improved after IBC, still I think right now we are lagging behind last couple of years, right? So I think what you're proposing is actually a market, well-functioning market where there is enough capital flow and there is a price discovery process where the banks can get a fair value for the securities. I think thanks for a wonderful presentation, and we actually took away a lot from this. Really thankful for that.
Thank you
and
so much for the
Rohit,
opportunity.
in particular, we bid adieu to your co-author. It clearly shows that it takes two brains to come up with such models, and you have been paying tribute to your co-author even
Yes.
after
Yes.
his passing.
Yes. Yes. Thank you.
And ladies and gentlemen, I don't see any Q&A as of now. So I will take this opportunity to thank our guest, Professor Rahulprasad from MDI, to joining us here and sharing his research. And thank you, my colleague, Professor Gopal Krishnan, to co-host the event with us. Stay tuned with us in the next few days. We may have a few more events coming up. Rohit, if you want to say, make a closing remark.
I would just thank you for the opportunity. I just want to say one thing, that when it comes to the National Bad Bank, I think it is absolutely vital that there is a level playing field between the National Bad Bank, which is the public sector ARC, and the private ARCs. And that level playing field does not exist as long as there is a sovereign guarantee. So I recommend removing the sovereign guarantee. There is an article that I've written in Mint a couple of months ago, which talks about the details of that proposal.
Mm-hmm. Okay, so the article in Mint that proposes to remove sovereign guarantee from the bad bank proposition.
Yes. Yeah.
Okay, on that note, ladies and gentlemen, thank you very much for being with us, and thank you, panelists. Have a wonderful night. Have a wonderful day.
Right.
Thank you.
Thank you.